Joining with his take on the global rally is RBC Capital Markets Chief U.S. Equity Strategist, Jonathan Golub. You know, it's so much this morning.
I love that sound we make before my name.
Yeah, they ring a bell for me. And
that
they go,
was me. That was me at 7 o'clock in the morning, still tongue-tied. All right, there's the bell for Keith. All right, so we got to keep a rein on him. Meanwhile, Jonathan, something you said recently, I was just reading, you said that what's shocking about the moves in the market in recent days is no specific catalyst for this sell-off.
Right.
Do you truly believe that? It wasn't China. It wasn't expectations of the Fed raising rates. There was no catalyst for the sell-off?
No, I mean, what you have is a recognition that there's greater global weakness. But here's what a catalyst is. A company goes bankrupt. Something fails. An event that, a storm that wipes out a city. Something where you can say that thing causes the world's, capital markets to shrink by 10% and wipe out hundreds of billions of dollars.
Okay, so why did it happen then?
I think that what you're going to find out is when this market bounces the way that it did yesterday and continues to bounce, and we make this stuff up over a period of a couple of weeks to a couple of months, then in fact what you had was a global growth scare that made people very uncomfortable. And once we get our hands around the fact that the U.S. economy is not going over a cliff,
you actually think the U.S. economy isn't that bad off? I
think the U.S. economy is weak, but weak is GDP of 2.25 or something like that, as opposed to...
What are you expecting this morning?
Well, we're talking about a period between March and June.
That's right.
And so the market is going to look at that and really not react at all, because that is...
Nobody cares? It's not going to be a market mover?
Nobody cares.
They care when the first one came out. This is the final.
What if it's not revised as high as expectations?
This won't matter, because what people care about is what is this going to mean going forward. So what they're going to care about is ISM is going to come out at the beginning of September, which is a read on what business managers think they're going to be doing. That's what the market's keyed on. But what have we learned here? China's weaker than many people thought. That one, frankly, you should have known, and the signs were very clear. We've been talking to clients about that.
I was going to say, what are you telling? How are you advising clients right now in this very uncertain and volatile environment?
Well, first of all, I think in the near term you're going to see a bounce. But if I look beyond that, we are in a slower growing world than we have been, for the
But what are you telling them to do? How are you telling them to act?
And in that slower growing world, you want to invest in companies that can continue to grow their businesses in that slow growth world.
For example, sectors, stocks.
New tech, not old tech.
Okay,
you have...
Are you talking social networking? Do you like that?
It could be social networking. It could be Apple. It could be Google. But those companies don't need to have a good economy in order... Apple doesn't need a good economy to sell more iPhones. They just need a new model of iPhone to come out. If you look at healthcare, the vast majority of healthcare is really not susceptible to the whims of the global economy. If you look at where those innovative brands are, and you have them in a lot of consumer brands as well, but if you look at where they're concentrated, they're almost all in the United States. If you look outside of the U.S., they really look like an old economy kind of
what do you
equity
think, Wallace,
market.
Keith?
The point that he's making was the point that worked up until 3 weeks ago. I mean, when you have a slow growth environment, which I think is a very important premise, like a lot of people just don't accept that. And a lot of people realize that when there is no growth, you buy organic growth. So I do agree with that. That is in healthcare, and it has been in technology. What I don't agree with is that it just magically happened. I mean, we have a late cycle slowdown in the U.S. We have deflation. We have profit and credit cycles going the wrong way for the first time. I could keep going. There's probably, there's volatility.
But I'm going to disagree with one thing you said. When you're talking about late cycle, what that means is we're anchoring on a cycle of 7 years. We're year 6. We're coming to the end. And if you're right, then you want to be running away from this market. Here's what I think happens.
Bingo. That's why I've been
right. But here's what this cycle is playing out. We are running.
By the way, he's advising clients be 75% cash, 25% treasuries.
And I think it's good. And I think that's going to be a huge mistake. So here's how I see it. When you have an economy that's growing not at 3.5, the way that it has for the last 40 or 50 years, but it's growing 2 to 2.5, the cycle gets extended. We don't burn through the capacity. So this is not your 6 of a 7-year cycle. It's your 6 of a 10, 12, 15-year cycle.
I love this one because it's different this time. We're going to have a different cycle. Again, that's...
I don't think it's a different cycle. I think it's a different for the rest of our lives. We are in a slower growing world. Demographics are a big issue. China has built way too much capacity that's going to have to be shed. And I think that we're talking about low inflation, low interest rates for a long time. But then the question is not, is that good or bad? What does it mean for stocks? recessions get pushed further out in the future. The economy is disappointing. There's two ways of playing it. You either get companies who grow their revenues or companies who can squeeze the heck out of margins.
No, I hear you. I mean, immediately when you're bearish, people say, oh, you're calling for a recession. I'm not. All year long, I bet at 1.4% to 1.6% GDP. That's half of what Wall Street's been for. I'm looking for that same level in the 10-year bond yield, 1.5-ish%. This is why the position's working. Stocks are down for the year to date. Bonds are up. This is why we've had the correction. The late cycle slowdown is being priced into the market.
All right. So
and I think that we're more agree on that economic backdrop. But go ahead.
All right. So we found some even ground there. But you like technology names.
Yes.
Some of them.
Right.
And you like healthcare.
I like healthcare and a bunch of consumer.
All right. There you have it. Jonathan Golub, thank you for joining us. And good fair fight there. All right.